So hi, my name is Bryan. I'm going to be presenting the video forum, pretty much of valuation for finance 2, ULACIT. So the first question is valuation just about numbers? Well, valuation is something to hold on to like a life vest, as stated in the video. It gives you a chance to build an argument, even though valuation has numbers. It's pretty simple, as what was explained again. Just that the human being makes it a little bit more complex. As mentioned before, even though valuation has numbers, it is more like a story or a narrative of the company. When valuation goes bad, it is not because of the numbers, but more because of human mistake or the person creating the valuation. Is not being biased or is uncertain of the numbers they're evaluating. They are adding and making it more complex than what it really needs to be. So pretty much in the videos, what his name is, I forgot his name, Demandata. He mentioned that valuation is really simple, just that us humans make it really more complex than what it needs to be. Like I put it here, he explains it like, when you're doing valuation, explain it as if you were explaining a story. For the human being, it's really complex to explain numbers, right? That was something that he explained. It's really complex to explain numbers. But if you explain it as a story of the business, it becomes more simple and more easy to digest. So, why valuation ought to tell a story? Valuation should tell a story because it is a story of the company itself. That the valuation is being created for. When explaining numbers, it is not a natural behavior, as I stated before, that the human being pays attention to or easy to explain as storytelling. Storytelling is an easier way to grab those numbers and build an argument that you can explain. It is more of a natural human behavior, like I explained before. It's telling a story is a little bit more of a natural human behavior instead of having numbers and just explaining, trying to digest the numbers. So that's what he mentioned. Like he said, it's not really complex. It's just understanding it, digesting it, and explaining it properly, and you shouldn't get any problems. Next question: how do you estimate the cost of debt for non-traded companies? Sorry. There's two ways of doing it. You have the recent borrowing history, right? So many firms that are not rated still borrow money from banks and other financial institutions. By looking at the most recent borrowings made by a firm, we can get a sense of the type of default spreads being charged the firm and use these spreads to come up with the cost of debt. And the second way of doing it is by estimate a synthetic rating. An alternative is to pay the role of a rating agency and assign a rating to a firm based upon its financial ratios. This ratio is called a synthetic rating. To make this assessment, we begin with rated firms and examine the financial characteristics shared by firms with each rating class. Number 4, this one's very interesting actually. What is the difference between price enhancement and value enhancement? I had some difficulties understanding this through the videos. I actually reached out to my professor, Allan from ULACIT, and he explained to me more in details about it. So I'm going to start first with the value enhancement. In order to do any type of value enhancement, you need to have either one of these 4 criteria. So the value enhancement, everything that is done to enhance the value has to flow through one of these 4 steps, or like Dinondado said, one of these 4 recipes. Increase cash flow in existing assets, push up the future growth rate applied to cash flows, reduce risk and discount rate applied to cash flows, push off the day of closure, right? So those are some things that need to be taken into consideration when doing a value enhancement, right? To make a true value enhancement, it will need to go through one of the 4 above steps, like I mentioned. Most businesses, when they talk about value enhancement, and this is something that was mentioned in the video as well, they're really not talking about value enhancement. They're talking about price enhancement, which is above one. So this is something that needs to be checked with certainty on information you're evaluating. So when you're taking a look at value enhancement, make sure that you're actually looking at what is value enhancement, and that the business is not really giving you a price enhancement, right? So let me explain to you what a price enhancement is. A price enhancement, it seems that, well, this is an example of what a price enhancement is. This is not exactly what a price enhancement is. This is the example that he gave in the video. It seems that with just changing the name of a company and boosting of prices without changing the main function of the business, it will affect in a positive way. So in other words, a price enhancement is what companies are doing to increase their price in stock, right? They're doing this to increase the price of stock. Now, they're doing this based off of trends. Like, for example, when the .com boom came in, a lot of people were changing their names to, I don't know, XXXXYZ.com, right? Even though their main name was XXXYZ, right? But since there was a boom on the .com, then that's why they started doing that. When they did this, they would see a positive trend in the price of stock, anywhere from 150 to 180%, right? Upraise. Now, when they also saw the same effect happen when the boom started dying down, right? When the boom started dying down, a lot of people started taking their .com name out and just have the name without the just .com. When that happened, we saw the same effect, the same type of behavior where the spike in the stock price would rise. Again, anywhere from 150 to 180. Now, this is, when companies do this, sometimes they're doing it just because of the trend itself. But they have to be very careful because sometimes this doesn't really pay, it really, putting a .com on the name really doesn't have any type of benefit to the company if it doesn't follow their line of business, right? So let me just read the example. It seems that with just changing the name of company and boosting prices without changing the main function of the business, meaning that the business is doing the same type of work that they're doing on a daily basis, just changing the name itself, will affect in a positive way. The sales from anywhere from 150 to 180% represents is not steady and also not recommendable because the company could be following a trend, and sometimes these trends are not the best suit for the company. So doing these type of trends really doesn't fit well with the company, and maybe it's not. It doesn't look really well with investors, right? So it's not an accurate form to increase the cash flow. Again, this was an example that was given in the video. So those are the differences between price enhancement and value enhancement. Just make sure that when you're looking at the numbers and you're looking at value enhancement, that you're really understanding that this is value enhancement and not price enhancement, right? Number 5, explain in your own words the path to value creation. All right. Well, the principles of the path to value are as applicable to mature manufacturing companies as the emerging high-tech companies, from which the term originated. So this term is coming originally from those tech companies. The path to value is simply management's blueprint for deploying the company's unique capabilities and resources in a way that will boost corporate value by a multiple of 2, 3, or more. When milestones are clearly identified and resources properly deployed, this becomes an effective tool for significantly increasing the worth of the business. Okay, so how can you reduce cost? How can you reduce cost of capital? Well, we can do that using the WACC, right? The WACC, weighted average cost of capital, is the combined rate at which a company repays borrowed capital. A business mainly raises capital from debt financing and equity capital, and computing WACC involves adding the average cost of debt to the average cost of equity. According to the journal The Accountants, the reduction of WACC stretches the spread that lies between it and the return on invested capital to maximize shareholders' value. A company can reduce its WACC by cutting debt financing costs, lowering equity costs, and capital restructuring. To reduce the cost of capital, I will replace my long-term debt with short-term debt. So on number 7, the question number 7 says, explain 2 ways how cash flows can be measured. You pretty much need to understand who are we measuring this for, right? Who we're measuring the cash flows for. So the cash flows can be measured in these two ways. Obviously the cash flow to equity investors and the cash flow to the entire business. So like I said, you need to really decide first whom you're giving this information to. Once you decide that, then you see which cash flow measurement you're going to be taking into account. On number 8, why is it important to define reinvestment and cash flows projections? Okay, reinvestment considers into account acquisitions, research and development, and reinvestment. Also must consider the good. Okay, so when you're taking into account reinvestments, acquisitions, and research, you also need to take into consideration all the good. Well, obviously you're going to take into all the good, but you also need to take into consideration anything bad, right? You just don't want to show the good stuff and leave out the bad stuff of any bad acquisitions, any bad research and development projects that didn't go through, or any bad reinvestments. You want to take into account everything. Cash should, another thing, cash should not be added into reinvested into the reinvestment cash flows, because it's already something that's, cash should not be added to reinvested, as most of the cash is already being invested. So most of this cash is already being invested, so that's why when we're looking at the reinvestments, we're not taking into consideration cash. The importance of reinvestment is to get small revenue to obtain eventually a bigger gain. So obviously we're investing to eventually get a bigger gain, a bigger investment in revenue. And in order to do this, the business has to reinvest. This also needs to be balanced out, as it might create sustainability in the company. So yeah, you don't want to reinvest. You don't want to reinvest everything and leave yourself with nothing, because then at the end of the day, it might bite you in the butt. 9. What is the value of an asset in discounted cash flow valuation? The value of an asset in discounted cash flow is that it has to make money some point in time. There can never be negative assets. So it has to be always positive. There can't be negative assets. It doesn't exist. Discount valuation is a tool to measure intrinsic valuation, as it measures the expected cash flows of a business, the growth and the risk over time. 10. What is intrinsic value? This refers to the value of the company's stock, the stock, their currency, and the product determined through fundamental analysis without referencing market value, as mentioned by Aswat Damodaran. Stated in the first video, it's all about the business, pretty much. So this intrinsic value is all about the business. It's nothing else that doesn't involve the business. And it's pretty much a tool. That's what it is. The intrinsic value of the gold is its intrinsic value. How can you determine a risk-free asset? On a risk-free asset, the actual return is equal to the expected return. Therefore, there is no variance around the expected return. For an investment to be risk-free, it has to have the following: no default risk, no reinvestment risk. Number 12, explain difference between nominal versus real discount rate. A nominal interest rate is an interest rate that does not take inflation into account. So we're not still looking at inflation when we're talking about your nominal interest rate. When we're talking about the real discount rate, as opposed to the nominal, a real interest rate is an interest rate that does not take. Okay, so the real interest rate is the one that doesn't take the inflation into account. Opposed to the nominal interest rate, the real interest rate adjusts for inflation and gives the real rate of a bond or a loan. Got confused there a little bit on that one. Which are the risk-free rate characteristics? For an investment to be risk-free, as mentioned, it must have the following characteristics. No default risk and no reinvestment risk. Not all government securities are risk-free. That's something that he was mentioning in the video. You would think that all government securities would be risk-free. Wrong. That doesn't exist. There's always some type of risk. Number 14. What is an equity risk premium? Equity risk premium is a premium that investors charge for investing in the average equity, or in other words, it refers to the excess return that investing in the stock market provides over a risk-free rate. This excess return compensates investors for taking on relatively higher risk of equity investment, historical risk premium, and dynamic forward look premium. All right. So those are these. You have the equity risk, you have the historical risk premium, the dynamic forward look premium, and those are the three models of cost equity. Name two ways for estimating a risk premium for emerging market. Okay, so 2 ways pretty much. The adjusted risk premium is one, and the default spread country band is another one. So the additional risk associated with investing, this is just something I added there. The additional risk associated with investing in an international company rather than domestic markets, the country risk premium is higher, obviously, for developing markets than for developed nations. And these are the two ways for estimating it. The default spread country band, in this approach, the country equity risk premium is set to the default spread of the bond issued by the country. And then you have the adjusted risk premium. The country equity is based upon the volatility of the equity market relative to the government bond rate. Number 16, betas. Which are the determinants of betas? Nature of the product or service, so you need to really understand what's the nature of the product or service that's being offered. The operating leverage. How much leverage does the company have from their cost on these products? How much are they making? And then the financial leverage, of course, is how much are they borrowing, right? So this is pretty much the different determinants when it comes to the betas itself. What measures of relative risk can use if you do not like betas? So these are some examples. As what Bejarano was saying in the video, if you don't like using betas, you can calculate them in these other 6 modules, right? You don't have to betas to calculate relative risk. You can use accounting measures or even qualitative measures in order to measure relative risk, right? So these are you have your accounting earning volatility, your balance sheet ratios, your composite risk measures, your proxy measures, your debt cost base, your price variance model, and your APN multi-factors model. These are 6 different models you can use to calculate betas. Number 18, what is debt? Debt is broken down into the following, right? These are 5 factors. It has to give rise to a contractual commitment, which has to be met in a good time or bad. So debt is pretty much, well, on this example, is that you have to have like a contract saying you need to pay by this date, this time, and it has to be met, right? Failure to make the commitment can cause you control of the business. Obviously, if you don't make that payment, it could lead for them to give you a high interest rate, or you can lose. You can have collections coming after you, or you can eventually, if you don't pay your debt, you can go bankrupt. You can lose your business, etc. You start having them take assets. The following 2 may only be considered in certain circumstances. Correct. There's actually only 2. These are the 2 factors that need to be to consider debt in the U.S. These are other ones that we can use in Costa Rica on top of these 2, right? So for example, account payable, a supplier credit, but only if you are willing to make the interest expense explicit, and underfunded pensions and healthcare, but only if it's legal requirements that you cover an underfunding. So pretty much if your healthcare is a legal attribute that you need to pay. For example, in Costa Rica, you need to pay La Caja, and you need to pay, all your employees have to have La Caja insurance, then that's something that you need to pay. And if you don't pay, then you have a debt. Like, for example, we can add a couple soccer teams like Saprissa, Alajuela. They don't pay their debt with La Caja, then they go into problems, right? So that, like he mentioned these 2 as for the U.S., and these apply depending on the country you're in. This one definitely applies for Costa Rica. 19. Explain 3 ways to estimate growth. Growth can be measured in the following three forms. Look in the past is the historical growth, is earning per share is usually a good starting point for growth estimation. Look at what others are estimating, analyze estimate growth and earning per share for many firms. It is useful to know what their estimates are. Look at fundamentals. All growth earnings can be traced to two fundamentals: how much is being invested in new projects and what returns these projects are making for them. Growth becomes meaningless when companies' earnings go from positive to negative. It would just be considered a good year. There needs to be stability. So in other words, growth needs to be constant, right? If I see that one year I had positive growth and another year I had negative growth, but big, huge differences, then it just says that, the year that I had the very negative growth, just I had a bad year of sales. And against that other year when I had a high spike, I had a good year of sales. So growth needs to be constant, and if it's uptrending, it's uptrending constantly. No dips, at least not too much drastic dips. 20, what is terminal value? Name ways of estimating terminal values. Well, terminal value is the present value at a future point in time of all future cash flows. When we expect stable growth rate forever, it is the most often used in multi-stage discounted cash flows analysis and allows for the limitation of cash flow projections to a several year period. These are the different ways to estimate terminal value. You have liquidation value, used normally when you want to sell the business, pretty much. Multiple approach, assume a going value that your cash flow will continue. This is considering the easiest approach. Then the stable growth model, technically the most used model, but requires that you make judgments about when the firm will grow at a stable rate, which it can sustain forever. Even though it is the most used, it is considered not the recommended one. Perfect, so this is the last question. It was a very interesting video forum. I did gain a lot of information, and this is pretty much it. Thank you.